Hi, I'm John. Today we're going to talk about your deal team if you're buying a business or selling a business. Let's talk about your attorney first. You want a business transaction attorney. You don't want an estate attorney, you don't want a real estate attorney, you want a business transaction attorney. By not having a business transaction attorney, it's going to cost you time and money. Let me give you an example. A doctor who works on your heart has been to medical school. A doctor who works on your foot has gone to medical school. They're both doctors. They simply have different specialties. Do you want a podiatrist to work on your heart? No, because they don't have experience in working on your heart. Well, if you're selling a business or buying a business and you're working with an attorney that doesn't have business transaction experience, in essence, that's the same thing as having a podiatrist work on your heart. I can tell you from experience that all attorneys claim they can do it. They don't realize there's a lot more complexities to selling a business or buying a business than there is for a piece of real estate. Attorneys are paid by the hour whether a transaction happens or not. You want a competent attorney that's not going to intentionally sink a transaction because they would have more risk if the transaction went through and they did something wrong. You want an attorney that's going to try and put a marriage together. You don't want an attorney that's focused on a divorce. Yes, you do plan for that divorce, but you want an attorney that's looking and working towards that marriage. And it's a compromise. The nature of buying a business is a compromise, and you want an attorney that will make compromises and work to make a transaction happen. Let me talk to you about something that's happened in every transaction I've been involved in. And that's when you have an attorney that's representing a seller and an attorney that's representing a buyer, and they're in two different states. The buyer's attorney will put the purchase and sales agreement together, stating that any future disputes will be settled under the home state of the buyer. Every single time, the seller's attorney will cross that out and put future disputes will be settled under the state of the seller. Now, it's one thing if the attorneys were looking to settle under the laws that were most advantageous to you. The fact is, the attorneys are looking down the road. If there's a dispute, they want to be able to help you with that dispute. If it's under the buyer's home state and you're the seller, and they're not licensed in that state, they cannot help you, and vice versa. I can tell you it always ends up being under the buyer's home state. I just saved you $500 because the attorneys would eat that up. Let's talk about your CPA. As a commercial lender, I got to the point where I classified my CPA in three categories. There was the level 1 CPA, and their thing was minimizing taxes. So when people didn't want to pay taxes, they'd go to that level 1 CPA. The level 2 CPA said, we're going to leave some money on that tax return in case you ever need a loan, the bank can see how they're going to get repaid. And because many people potentially could need a bank loan, they went to that level 2 CPA. That level 3 CPA says, come with me, I'm going to help you grow your business, and taxes will be a consequence of our success. Which level CPA do you have? Which level CPA do you want? Now, in fairness to CPAs, they will tell you that they provide the level of service that their clients want. So this could be on you. Let's talk a moment about the advisor that will help you sell your business or buy a business. They go by different names: business broker, mergers and acquisition advisor, business intermediary, and investment banker. We'll talk a little bit about the differences in the future, but for now we'll just call them a business broker. You want a business broker or mergers and acquisition advisor that has experience in selling your type of business. And the reason for that is because they know and understand the numbers, and if there's an issue with the numbers, they know immediately. Let me give you an example. We had a client that was looking to sell their business. When we got the tax returns, we immediately knew there was a problem. The seller was unaware of it, but what we did was we scheduled a conference call with the seller and their accountant. We talked it over and we were able to pinpoint the problem. The taxes were prepared incorrectly. The seller then went and had the taxes prepared correctly by a different CPA. We were able to take it to market and we sold that business. By us being experienced in selling this type of business, engineering, we were able to identify that problem up front. If we had not identified that problem up front, we would have spent time and money, and the seller would not have sold their business. So you want somebody who understands your business. Second, you want somebody who has a track record of success. Have they sold businesses? Have they sold your type of businesses? And how many sales do they have? Now, you can't just look at the raw number to say this person is more successful or less successful based on the number of sales, because the larger the sales and the more complex the sales, the fewer transactions they'll have per year. Third, you need somebody who understands the numbers and can explain the numbers to people in plain English. You don't want somebody who's going to talk in jargon and talk about EBITDA and seller's discretionary cash flow and debt service coverage. You want somebody who can explain what those terms mean in simple and plain language. When we talk about cash flow, we talk about EBITDA. But let's back up a moment. And what is cash flow? Cash flow is actually the measuring of cash and determining where it ends up. Now, there are two types of accounting methods. There's what we call cash accounting and accrual accounting. Cash accounting is making all the decisions based on money that hits the deposit account and money where the check is written or wired. That is cash. With an accrual basis, when the money's earned but not received, it hits the books, even if it has not been received. And when expenses are incurred, even if the check hasn't been written, they reflect that in the books. That's called an accrual method. Cash flow is measured using an accounting firm called EBITDA, earnings before interest, taxes, depreciation, amortization. What they're doing is they're taking the net income and they're adding back the non-cash expense of depreciation and amortization. And because another business may not incur money for interest, they also add that as back to that equation. When we talk about closely held businesses, we talk about seller's discretionary cash flow. And the reason we use that is because a business owner can pull the money out of the business in many different ways. The obvious ways is you could pull it out as net income, or you could pull it out as salary. But the owner could also pull that money out in other ways. If there's common ownership, meaning the person who owns the business also owns the real estate, they could pay a higher amount of rent, goes to the real estate trust, and then the person pulls it out of that real estate trust. They'll do that to save themselves taxes. Another difference could be is if you have a family member working in the business. Let's say that family member is working in the business, and if it was a non-family member, you'd only pay that person $20,000 a year. But because it's a family member, you're paying that person $50,000 a year. The difference of $30,000, the $50 what's being paid, the $20 of what they're actually worth, is $30,000. That $30,000 is added to seller's discretionary cash flow because a future owner won't pay that person $50,000 for a $20,000 a year job. Other examples could include paying for a car that is overpriced, over exotic, or maybe it's just simply used for personal needs. Well, a future owner wouldn't pay for that car, so that would be added to seller's discretionary cash flow. Let's talk about credit cards for a moment. Now, the types of businesses that we sell tend to be professional businesses, B2B type businesses. Credit cards are typically not a factor. But because some people who do not own these types of businesses may be watching these videos for educational purposes, I want to talk to you specifically about credit cards. There are perks to being an owner. Everybody knows there are perks to being an owner. When you're selling your business, you can recover those perks if they're provable and documentable. However, when you put something on your credit card, let's say you're running personal expenses through your credit card, those are considered lost expenses. Those are to the buyer's benefit, because nobody wants to sit through and go through 36 months or 48 months of credit card statements to pull up business expenses versus personal expenses. As a result, any personal expenses that are going through your credit cards are to the new owner's benefit. You're trying to capture all the different ways that the owner is pulling money from the business, either in cash or owner's perks. A seller's discretionary cash flow is the total money the seller could have put in their pockets if they had desired to.